Well, the big headline today is the fact that US President Donald Trump and Chinese President Xi Jinping have agreed to a truce on trade war that has weighed heavily on the global equity markets for most of 2018. Now, the two leaders who met for dinner on Saturday at the G20 summit in Argentina agreed to hold off on additional tariffs on each other's goods after January 1st as talks continue between both the countries. Now, remember, Trump has agreed that on January 1st, 2019, he will leave the tariffs on $200 billion worth of product at 10% and not raise it to the 25% mark. And over the next 90 days, American as well as Chinese officials will continue to negotiate lingering disagreements, whether it's in technology transfer, intellectual property as well as agriculture. CNBC's Eunice Yoon reports with the details.
Well, the Chinese media is praising the deal, but maybe not all the points that the U.S. thinks is important. So both sides are breathing a sigh of relief that the tariffs are on hold, at least for now. And manufacturers here are particularly pleased that the current 10% tariffs that are in place won't kick up to 25% on January 1st, which was the original White House plan. Now, in terms of where they differ, the Chinese and the U.S. have said that they are going to have a discussion now for the next 90 days to come to some sort of agreement on how to go forward. Well, the U.S. says that they're going to discuss tough issues such as forced technology transfers, but in the Chinese state press, there is very little discussion about forced technology transfers or, for example, the fact that from the U.S.'s perspective, the Chinese state subsidizes certain industries. Those issues are not being discussed in the state press. Instead, the Chinese state press is focusing more on China's efforts to reform and open up, and that they're going to increase their market access for certain companies. But again, the reiteration is as long as it's good for the Chinese people. The other issue that has been raised quite a bit is that there isn't any real number on exactly how much the Chinese are going to purchase in terms of their agricultural products.
All right, so that is as far as the peace pipe which had been blown between trade war fears or between Donald Trump and Xi Jinping. On the back of that, the Asian market is doing fairly well as we speak. Pull up the Nikkei, that one's higher by about 1.3%. We have the Korean index too high by about 1.6%. So the Asian markets nearing the high point of the day on the back of that, in fact, led by the moves that we're seeing in Dow futures, which is up about 400 points as well. In that regard, the SGX Nifty is doing fairly well. That one should come up for you as well. The SGX Nifty up around 75 points as we speak, and that's primarily on account of the strength that we're seeing in the Asian markets as well as the global markets. But for us, the key cues, of course, will be what happens with the macro data as well as how we react to higher crude. All right, with that, we have some opinion coming in from Seth Freeman. Seth, good morning. What do you make of the peace pipe that has been blown between Donald Trump as well as Xi Jinping? What do you think one makes of this? Is this likely to be held on to?
Well, we're looking at, just essentially a 90-day pause. And there's a lot of negotiations that need to take place. And although, this morning in Asia, already this evening here on the West Coast, we're already seeing the reaction, especially in the ag and oil sector.
How big do you Seth, okay, I think we have lost that connection. Okay, Seth, can you hear us now?
Yes, I can hear you.
So Seth, we take your point as far as the 90-day truce that you mentioned, but overall, how big do you think this particular fall was? Because recently we had seen a lot of FANG stocks coming under a bit of pressure. So what's your overall analysis when it comes to the U.S. equities going forward?
Well, we saw the futures are already up for tomorrow, and so that's looking positive. It is positive, but in a way it sort of extends the environment of uncertainty. And in terms of making plans or looking at near-term strategies, this is difficult for both institutional investors and, frankly, retail investors. And we're coming into a period of the year where there's generally lower trading volumes. So small changes in pricing can really appear to be the appearance of greater volatility.
Well, Seth, in that case, all the cues now put on the table. What would your asset allocation strategy be? More importantly, your strategy towards developed markets versus emerging markets, would that change?
Well, I think we're going to continue seeing investors move into income-oriented securities and most likely not really be significantly adding to equity positions. And part of that reflects two things: expectations that interest rates will stay the same or actually continue moving up, and that in 2019, a slower economic growth. In terms of developed countries, I was looking at some charts earlier today, and although emerging markets have become less expensive in the last few weeks, I still think that in relative terms, given, with the exception, frankly, of India, given the risks, that the U.S. market will still be preferable.
Okay, so the emerging market valuations have corrected a tad bit. But Seth, what's your overall call on India? You mentioned that the valuations are still towards the fair mark when it comes to India. What's your overall call on India going forward?
Well, as you know, I've been passionate about India for nearly 15 years, and that doesn't change from a long-term perspective. But we're also coming into a period of some elections in India. I'm very concerned about India and Russia getting closer, and India and China, and certain strategic, arms and other kinds of relationships between India and those two countries. I think that raises some political problems, especially in this current environment.
Okay, Seth, thank you so much for joining us with that perspective. So trade truce is what is making headlines today, and we will keep tracking that particular cue as well. Now, moving on to all the action in the global markets now. Wall Street ended with strong gains on Friday after a volatile month. The stocks gained on renewed hopes that a trade deal between US and China could be signed at the G20 meet in Argentina. Now, those hopes did live true over the weekend as the trade truce was called, and that's the reason Dow futures suggest an uptick of around 400 points. Remember, the Dow was an outperformer on Friday itself because it ended around 200 points higher, and this was followed by S&P 500 and Nasdaq as well. That gained over 1% in trade each. In fact, on that note, here is some opinion from Wharton School professor Jeremy Seal on the key triggers for the U.S. market going forward. Take a look.
If you take the betting markets, there's a real strong probability Democrats take the Senate and the presidency and keep the House. And the betting markets say it's almost 50-50. Now you get to an unraveling of the corporate tax cuts, which I believe are a major source of the rally that we've seen over the last 12, 18 months in the market. So it is a concern going forward. Trump's position, and now that he can't blame Powell, certainly we're going to see December 19th, the meeting, but he can't blame Powell for a bad stock market because if the Fed is taking the foot off the accelerator, well, then everyone's looking at him and tariffs, and he doesn't want to be the cause of a bear market in 2019 either.
All right, so with that, what we do is we take a look at what happens because now all eyes are on the U.S. Federal Reserve meet on the 18th and 19th December. And Minneapolis Fed President Neil Kashkari says the rates are close to neutral, and raising rates too forcefully before necessary could actually risk causing a recession in the U.S. economy. Hear him out.
So for 3 years since I've been at the Fed, we have been surprised by the labor market. We keep thinking we're at maximum employment, and then wage growth is tepid, and the headline unemployment rate drops further. Inflation has been well under control, and 200,000 jobs a month, like clockwork, are being created by the U.S. economy. My basic message is if the U.S. economy is creating 200,000 jobs a month, month after month, we're not at maximum employment. Inflation expectations are so anchored because of the political independence of the Fed, because the Fed has done a good job over the last 20 or 30 years. That, to me, is something that's enabling this economy to continue to strengthen, enabling the job market to continue to strengthen without inflation taking off. And so let's let it continue. There's a lot of uncertainty around where the neutral rate is. I think we're close to neutral, maybe not quite there yet, but close. I look at the data, look at inflation expectations, look at wage growth, and look at job growth. All of that says there's still slack.
All right, across the Atlantic then, the European markets, they ended lower with investors keenly watching the world leaders convene at the G20 summit. So the European markets, unfortunately, did not move higher with the US markets, or the US markets moved a little higher in anticipation of perhaps this peace pipe being blown. But the European markets shut just ahead of the meeting, which is why we saw a cut of about mild 58, 60 points on the FTSE, the CAC, as well as the DAX, seeing a cut of anywhere between the flat line to about 0.4%. The FTSE was the key underperformer there, closing 0.8% in the red, as investors continue to be skeptical on UK Prime Minister Theresa May's Brexit deal. The German DAX, like I said, ended 40 points lower, while the French index ended just below that red line. In the emerging market space, though, we saw some money being pulled out of the Russian as well as the Brazilian indices. The Russian index sitting with a cut of about 0.3%, while the Brazilian index also ended lower by about 0.25%.
Okay, let's shift focus now to the world of commodities, because oil prices gained close to 3% this morning after slumping over 20% in the month of November amid concerns of oversupply and global politics. Remember, all eyes now on the crucial OPEC meet on December 6th, where there is a widespread expectation that OPEC and Russia would agree to some form of production cut. The Brent right now hovering over the $61 per barrel mark.
Perhaps isn't enough to stop the continued decline in the price that we've seen over the course of this past month, which has been very dramatic and has a lot of momentum, has a lot of weight of fast money behind it. So I would say that unless we see a surprise coming out of the OPEC meetings Thursday or Friday, we're probably going to see continued weakness in the price leading right up till Christmas. In terms of actual production cuts, I don't see much political will coming from Saudi either. So if Saudi and the Russians both are not politically motivated to have a drastic cut, and certainly the US and Iran trying to put out as much product as possible in the coming months, we probably see an environment where, unless we see drastic action, we're going to have prices fall.
All right, from there we'll move on to the currency space. Then the dollar weakens as investor demand for riskier assets rise after China and the US agree to a ceasefire in the trade dispute. Meanwhile, safe haven yen strengthens versus the US dollar.
On that note, let's slip into a quick break. Come back, we'll discuss all the cues and news you need to know for trade this Monday morning. Stay tuned.